Are high yield dividend stocks really safe? In this episode, we're going to take a look at some of the most popular dividend stocks. We're going to take a look at their dividend safety, and we're going to understand what compromises this. Firstly, it is their free cash flow payout, which we will discuss, as well as their net debt to EBITDA, which we will run through for all of these popular stocks in the dividend community. We're also going to look at the performance of these stocks to see if there is any underlying comparison that we can draw. And also we are going to run them through our stock valuation model to see whether or not any of these companies are trading with a very high margin of safety that does make them an acceptable buy in today's climate. Now, the first company that we are going to look at is 3M, and we can see this company has been hammered down 22% year to date, trading towards its 52-week low with a yield of 6.3%. Now, in terms of the dividend safety score, what we see is a score of 40, which does make it unsafe. And now what compromises this score and what leads to this unsafe are made up of two things generally. The first one, the free cash flow payout. Now, what this essentially shows is the percentage of a company payout in relation to the free cash flow generated. And what we typically like to see for this is below 60%. The reason for this is dividend growth investors, we like to see below 60 as we believe management will have the ability to offer those double-digit dividends we love to see. Now, for 3M, we can see over the last 10 years, it has been pretty much below that 60% target. 2022, it has come slightly higher at 88%, and in 2023, it is expected to go even higher at 90%, which does cause worry for that all-important dividend safety score that we see as 40 right now. Now, it's not only the free cash flow payout that attributes to the dividend safety score of any of these companies, but it is also that net debt to EBITDA. And what this signals here is the number of years it would take the company to pay off all of their debt net of cash on hand. And typically for most companies, we like to see this below 3. And for those that are wondering, EBITDA stands for earnings before interest, tax, depreciation, and amortization. Now for 3M in particular, it did reach its peak at 2.46 in 2019 and has come down ever since to around 1.39, with 2023 expected to come down even lower. Now, it is worth noting, though, that when their free cash flow payout does increase, this does really stress the business, as it essentially means they are paying out a significant portion of their free cash flow in dividends, and that is why we see that dividend safety score for 3M at 40 as unsafe. Now, in terms of the valuation model for 3M, and we'll run through this for every single company that we're about to take a look at, we typically on the channel review the stocks. We run through all of the formulas, Graham's valuation model, the multiples valuation, the dividend discount model, and the discounted cash flow model. However, we will jump straight to the output for all of these stocks today. And right now we're interested in the intrinsic value, and this is essentially the average of the models that we do use. Do know on some of these episodes we do run through and explain why some of these models are irrelevant for certain companies. So the current price of 3M is around $95.34, and typically we would start off with a 10% margin of safety if we believe the company has a wide moat, strong financial metrics, and good forward-looking data. Now, this is very subjective depending on the investor's preference and risk style. So for those looking at a higher rate at 15%, it would be a buy of roughly at the current trading price. Therefore, based on the estimates and judgments in our model, for 3M you are getting a 15% margin of safety. And Wall Street, they do believe the price will go up to around $110 over the next 12 months, roughly in line with our intrinsic value, therefore signaling they do believe it to be a buy. Now, we are running through 9 stocks today, and before we jump onto the second stock, which is AT&T, we will also, towards the end of the episode, take a look at the total return of all of these 9 companies, see if there are any similarities year to date as well as the last 5 years. So let's jump into AT&T. We can see it is down 15% year to date, trading towards the mid to lower end of the 52-week range, with a yield sitting right there at 7%. Now, in terms of the dividend safety, we have a score here of 60, making it borderline safe. And again, what compromises this, we will start off with that all-important free cash flow. Now, for those that don't know and that we didn't mention at the beginning, we tend to ignore the earnings payout ratio. The reason for this is that it is susceptible to manipulation by management through accounting, so we find the free cash flow more accurate and relevant for our analysis. So one thing to note, whilst we look for 60% for the majority of companies, for telecoms we increase this to around 70%. Now, for the last 10 years, what we can see, again, it has been below 70% for the majority of this period. And we can see from 2018 to 2022, it was between 50 to 60%, which is positive for that dividend safety score. And it is expected to come down around 40 to 45%. And therefore, we are starting to see why it has a much safer score than the 3M that we analyzed at the beginning. And then when we take a look at their net debt to EBITDA, below 3.5 for telecoms, we can see it straddling around that 3.5 level, with 2022 coming in at 3.47 and 2023 expected to be slightly lower, which does give a bit of breathing room for that dividend payment that AT&T do pay out. So then jumping onto their valuation model, is there any margin of safety with this company currently? And remember, the intrinsic value here is just the average of the models. So the current price, as we can see, sitting around $15.90, with our intrinsic value coming to $22.31. Starting off with our margin of safety of 10%, it is a buy up to $20. Moving that on to 15%, a buy up to $18.96. And if we keep going, we can essentially get to the point where we do find what the essential level is of margin of safety we are getting. So we can see here with a 30% margin of safety, you would be looking at a buy up to $15.62. So right now with AT&T, based on our estimates, you are getting between a 25 to 30% margin of safety. And we can see Wall Street also believe this to have some significant upside over the next 12 months at around $20, a $2 short of our intrinsic value calculated. Moving on to our third stock, we have Verizon. Now this company is down around 10% year to date, trading towards the midpoint of the 52-week range, offering a forward yield of over 7%. Now, in terms of their dividend safety score, we see this sitting at 70, and it does have a market cap around 152 billion, so it is a mega cap company. Jumping onto their free cash flow payout, remember for telecoms, 70% is the top target of what we like to see, preferably below that. And we can see it has had a mixed period over the last 10 years, and unfortunately 2022 sitting at 104%. And just to point out, this is why we do look at the free cash flow, because if you were to look at 2022 on the earnings, you would think there is nothing wrong with the company. But what this is signaling, in 2022, Verizon did pay out more in dividends than they generated in free cash flow. Now, the only positive to take from this is that it is expected in 2023 to come down below that 100%, but we can see why we are not seeing a perfect score of dividend safety just yet for Verizon. And then when we move on to their net debt to EBITDA, below 3.5 again for the telecoms, we actually see it doing the opposite. We see it going up rather than down, which is what we like to see. 3.37 in 2022. Now that is getting quite close to the 3.5 target that we like to set. But again, it is expected to come down very slightly in 2023. Now taking a look at the valuation to see the margin of safety. And as always, if you do enjoy the content, value is being provided, do hit that like button. In fact, smash the like button, hit the subscribing bell to be continually notified of these videos as they drop. So with Verizon, what we calculate is an intrinsic value of $36.26. And interestingly, the current price is sitting right there. So we believe that Verizon is currently trading at its intrinsic value. Therefore, you would be getting a 0% margin of safety on the stock right now. In terms of Wall Street and what they believe, well, they do see some upside to the current trading price, just shy of 10%. So again, this is what we have calculated for Verizon. And as always, do not copy what Wall Street do, but this is one part of the research that we have as analyzing stocks on the channel. Now, the fourth stock out of the 9 that we are reviewing is EPD, Enterprise Product Partners. It is up, in fact, 8% year to date. It is trading towards the mid to upper end of the 52-week range with a yield of 7.61%. Now, in terms of its dividend safety, we see a score of 65, making it safe. And when we take a look at their payout, now it is oil and gas company and an MLP, so we do actually focus on the DCF rather than the free cash flow, distributable cash flow paid out. And what this is essentially saying is we are looking below 90%. And what we can see for EPD is, in fact, it has been not only below 90% over the last 10 years. In fact, it has been around 60% for the majority of the period, which is positive to see for that dividend safety, with 2022 at 54% and 2023 expected to be in line. Now, in terms of the net debt to EBITDA, for MLPs, we can see this goes up to 4.5. However, over the last 5 to 6 years, it has been below that considerably. And in 2022, we are seeing that at 3.02, with 2023 expected to be slightly lower at 2.99, which is positive for the dividend safety aspect of this company. Now, when taking a look at the valuation of EPD, remember intrinsic value, the average, we see the intrinsic value come to $42.57, which is significantly higher than the current price of $26. So if we do start off with a 30% margin of safety, we can see it is still a buy up to $29.80. When we move that to 35%, we see it still is a buy, and at 40%, you would be looking at $25. So what we are saying is right now for EPD, you are getting between a 35 to 40% margin, and Wall Street, they have forecasted over the next 12 months, whilst they don't believe it to be as high as our intrinsic value, they do believe it to go up to around $32, so they do believe EPD is a strong buy in the current market. Now moving on to stock number 5, and with these stocks, as we move on, the yield does get higher. So we have Enbridge here, currently down 13.71% year to date, with a yield heading towards 8% at 7.79. Now, in terms of Enbridge's dividend safety, we see a score here of 70, which is positive to see, especially when you look at yields that are above 7%. Again, similar to EPD, we do focus on the distributable cash flow for pipeline companies, and below 70% is what we target, and what we can see, very positive for a company with a yield over 7%, to see that sitting below 70% consistently over the last few years, with 2023 expected again to be below 70%. Now, taking a look at their net debt to EBITDA, now yes, for pipeline companies, below 4.5 is what we look for, and for Enbridge, it has been slightly higher than that over the last few years. It's currently sitting at 5.06, but do note in 2023, they are expecting this to be roughly in line with our 4.5 target that we like to see. Now, in terms of the valuation for this company, what we are looking for here is a nice margin of safety, as always, whenever we are looking to purchase stocks. And remember, if you do enjoy the content, do hit that like button, do hit the bell and subscribe so you are continually notified of these videos. So our intrinsic value comes to $42.18 for Enbridge, with the current price sitting at $33.68. Now, starting off at 10%, as we normally do on the channel, you would be looking for a buy up to $38. Bumping this up to 20%, you would be looking essentially at the current trading price. Therefore, if you were to lock in a price at the current market value for Enbridge, based on our estimates, you would be getting a 20% margin of safety. And Wall Street effectively say they do believe the share price to go up around 20% to $39.50. So with Enbridge, based on our estimates and Wall Street's estimates, you would be locking in a 20% margin of safety with 20% upside. Moving on to stock number 6, we have BTI, British American Tobacco. Now, this is down 22% year to date, trading towards its 52-week low. With a yield now, we're moving into the 9%. Now, in terms of their dividend safety, we see here that they have a score of 45, making it borderline safe. Now, when we take a look at their free cash flow payout, what we typically like to see for tobacco companies is below 85%. Do note that tobacco companies do pay out a majority of their earnings and free cash flow as dividends. And what we can see here, in fact, over the last 10 years, it has been significantly below that 85%, with the last 5 years, in fact, being around 50%, and 2023 again expected to be in the mid-50s, which is a very positive sign. Now, when we take a look at their net debt to EBITDA, below 3 for tobacco companies, and over the last few years, it has been effectively at that 3 mark, with 2022 coming at 2.96. And 2023 expected to be around 2.82, 2.85. So that is positive to see, especially given it has come down from its 2017 figure of 5.28. Now, looking at the valuation of British American Tobacco, what we can see when we take a look at that intrinsic value is that it comes to around $55, with the current price sitting at $31. So a margin of safety at 10% shows that it is a buy up to $50, at 20% a buy up to $44, at 30% a buy up to $38, and at 40% still a buy at $33. And if we look at 45%, it wouldn't be a buy just yet. So you are getting between a 40 to 45% margin of safety on BTI, and Wall Street do forecast upside to around $45. So Wall Street do essentially say they do see this share price going up by around 50% over the next 12 months. So in relation to our analysis, you would be locking in a 40% margin of safety with a 50% upside per Wall Street. Now, before jumping into stock number 7, just to let you know, you can pick up a copy of the stock valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio to get to your own margin of safety by clicking on the pinned comment below and picking one up. Now, jumping into stock number 7, we have Walgreens Boots Alliance. And this stock is down 43% year to date, trading right there at that 52-week low with a yield now of over 9%. Now, in terms of their dividend safety, we do see a fairly low score of 30, making it unsafe. And when we take a look at that free cash flow payout, it does tell you a story in itself. Now, below 40% is what we ideally like to see for consumer retails. Now, on average, I would say 60% is okay as well. But what we can see in 2022, whilst it was above that 60% very slightly, 2023 is a very bad sight for sore eyes. And what this is effectively saying is that the company paid out 1,175% in dividends as a percentage of their free cash flow. So they are paying far more in dividends in 2023 than they did generate in free cash flow. Now, in relation to their net debt to EBITDA, what we can see here is whilst we like to see below 3, the majority of the last 10 years it has been above that 3 target, 2023 at 3.29, and 2024 is expected to climb over that figure to 3.68. And if you wanted my opinion for Walgreens, I do see another dividend cut incoming. Now, in terms of the valuation for Walgreens, and don't forget, please do, if you enjoy the content, smash that like button. It helps increase our community. It helps me show that you enjoy this and value is being provided, and I will do similar content going forwards. So the intrinsic value comes to $29.18, current price at $21. Now, a margin of safety at 10% would show a buy at $26. Remember, these figures are very essentially dependent upon your choice as an investor. And at 20%, we can see it as a buy at around $23. And at 25%, again, a buy at the current price. So you are locking in, based on our estimates and judgments, a 25% margin of safety, with Wall Street expecting the share price, in fact, to go even higher than our intrinsic value. So they see a very strong 50% upside. And as we estimated, a 25% margin of safety in the current market. Don't forget, you can grab a copy of the valuation model that we do run through on a regular basis on the channel to get to the intrinsic value and acceptable buy price of companies in your own portfolio by clicking on that pinned comment below. Now, jumping into the penultimate stock, we have Ultra, ticker symbol MO. Now, they do offer a yield of 9.6% currently, trading towards that 52-week low with a year-to-date loss of 10%. Now, in terms of their dividend safety, a score of 55, making them borderline safe. If we look at their free cash flow, now below 85%, if you remember, for tobacco companies. Now, for the majority of the period, it has been below that 85% or near enough to it. We do see a period of 2016 to 2017 where it was above 100%, but over the last few years, and in fact 2022 at 73% and 2023 expected to be slightly higher, it still does look like the free cash flow payout is looking fairly reasonable. Now, jumping into their net debt to EBITDA, and remember 3 for the majority of the companies and including the tobacco companies. From 2018, where it hit its peak at 2.54, it has started to come down. In 2022 at 1.85, and what we can see in 2023 expected to be roughly around that. Now, in terms of the valuation for Altria Group, when we take a look at that intrinsic value, what we can see is that there is some nice upside to the current trading price. So we see the intrinsic value come to $56 with the current trading price at around $41. Now, if we start off with a 25% margin of safety, we do see it is a buy up to $42. And if we move that to 30%, we can see it is slightly lower. So based on our estimates and judgments, you are getting a 25% margin of safety to 30% on the current price. And Wall Street, whilst they don't believe it to be go as high as our intrinsic value, they do see it to go around $47 over the next 12 months, signaling around a 20% upside to current trading price. Now, we move on to the last stock that we are analyzing on the channel, Medical Properties Trust. It is one that we have reviewed in depth on the channel just yesterday, so do go check that out if you want to see an in-detail review. Now, it is down 60% year to date. It is trading right there at the 52-week low with a yield of over 13%. Now, in terms of their dividend safety, which is quite important when you are locking in a high yield, we can see it here, a score of 20, making it very unsafe. Now, a few reasons why this is essentially the score that we see. Now, remember with REITs, we tend to look at the adjusted FFO, funds from operation payout, and not the free cash flow that we like to look at for normal companies. What we can see below 95% is what we aim for, and it has only really breached that once in 2019, with the last few years at around 82%, and 2023 expected to go even lower. Now, in terms of their net debt to EBITDA, now this does show the quality of the balance sheet slightly when we do analyze that total cash versus total debt, because what we're seeing here is, whilst we like medical building REITs to be slightly higher than our typical companies at 6, MPW has had that for the majority well above that 6. 8 in 2021, 7.55 in 2022, and expected to go even higher above 8, the highest it's been in 2023. So that does give some cause for concern for that dividend safety that we see, as well as the fact that they did in fact have a dividend cut in August this year. Now, if we put that to one side, what does the valuation say? Well, for MPW, remember the intrinsic value is just the average of the models, and with REITs, we tend to ignore the Graham's valuation as it's not appropriate. So it comes to $10.57. Now, the current price is down at around $4.61, so this means you are getting a significant margin of safety. And remember, we don't buy or sell stocks purely based on a margin of safety. There is other research that we do, so do go check out the other stocks that we review on the channel in detail to understand all the different factors that we incorporate before looking to buy or sell a stock. Now, margin of safety, you are getting a 50% margin of safety. If we bump that to 55, you can see right now you are getting around a 55% margin of safety. And in terms of Wall Street, well, they do see some nice upside to the current trading price, again at around 50%, and you are locking in, based on our analysis, a 55% margin of safety. Now, before we wrap up the video, what we do want to do is take a look at the total return of the companies over the last 5 years and year to date to see if there are any similarities. And don't forget, if you have been enjoying the content, to smash that like button, hit that subscribe bell so you are continually notified of these high quality videos as they drop on a daily basis. Now, before we do take a look at this, just to remind you, if you do want to grab a copy of the valuation models to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. So let's jump straight into it. So year to date, now total return effectively shows with those dividends reinvested. But remember, this is just one part of any analysis we do on the channel, as historical performance is never indicative of the future. So what we can see on the channel is realistically only one of these stocks, if you take a look, has had a positive return year to date, and that is EPD. As we can see here, with all the other stocks, they have had a negative return. If you just take a look, all of these below that 0%, effectively showing year to date, they have had a negative performance, which is never great in any of the shares that you do want to invest in. But when we expand this over the last 5 years, and as always, when you have the data available, do look at 5 years worth, we in fact see that more than half of the stocks also have a negative return over the last 5 years. And the ones that have a positive one are MO, Ultra Group, BTI, British American Tobacco, ENB, Enbridge, and EPD Enterprise Products, with the other ones all being negative over the last 5 years. So that is an interesting story. Whilst we see year to date, the majority of the stocks are down. Over the last 5 years, about 4 of the 9 are in fact positive, and only marginally as well, with EPD and ENB being the most positive out of them all. So do let me know your thoughts in the comments below. Do you believe from the information that we have gone through that high yield dividend stocks are in fact safe? Do you have any questions in terms of the safety of any of those that we did run through in particular? And just genuinely know what you thought of the video today. As always, do smash that like button if you enjoyed the content. Do let me know the value is being created. It does help us grow our channel and push the video out to more investors out there. And as always, if you're new to the channel, do hit that like button and subscribe. Hit the bell so you are continually notified of these videos as we drop, as they do come on a regular basis. And finally, just for those that are new to the channel and do want to grab a copy of the valuation model, click on that pinned comment below where you can essentially run through your own companies in your portfolio through the model, or if you want to, you can also run through any of those that we went in today's episode, but with your own estimates and analysis. As always, have a great day. Catch you on the next episode. Let me know your thoughts in the comments below, and see you on the next one.